What's up guys, Steel Arms here with Samurai Markets and welcome back to another video. In this video, we're going to be discussing the most basic concept of day trading known as support and resistance. This is a very common topic, it is very misunderstood and not a lot of people know how to utilize these zones and key levels properly. In this video, I'm going to teach you guys how to draw your zones and key levels quickly and effectively and make sure they're reliable and accurate. So make sure you guys like and subscribe and leave a comment for any future videos you'd like to see. And now it's time to chart and I'll see you guys in the setup. Alright guys, we're here at the setup, and before we go over TradingView and actually look at live charts, I want to go over this PowerPoint which contains some details that it's going to help you out and answer some questions. So before we get started, I want to discuss support and resistance, zones, key levels, trends, and time frames. So what's support and resistance? Support is considered the floor where price can reject and bounce or continue breaking down, right? This is usually it's usually below resistance, right? So when you're bouncing, right, if you're just jumping around, you're bouncing off your support, right? You're bouncing off the floor, right? And let's say you jump really high and you break through or hit the ceiling, that's considered your resistance, right? So resistance is considered the ceiling where price can reject and drop or continue breaking out. So, it could break out if you jump high enough or with enough power, you could break through the ceiling like Superman and just keep shooting through. Or just hit the ceiling and just reject and just drop. So that's the basic concept of support and resistance. That's all it really is. So now to understand support and resistance, you have to understand a couple of things, which we're going to go over right now. Zones and key levels. So zones are your area on the chart where price can react to, right? You have your support zone, which some people call demand zone, and you could expect a bounce here. You also have your resistance zone, also called supply zone, where you could expect a rejection. However, these zones could also be used for breakout trading as well. Price could break below support and continue breaking down or break out of resistance and continue breaking out. So when you're marking your zones, you want to look for obvious levels on the chart where there has been consistent reaction to, right? Either price has been rejecting that level or breaking out of it and retesting it. You just want to see price has been reacting to that area on the chart. Moving on, mixing with zones, you have key levels as well, right? Key levels are specific price points on the chart for breakout trading, right? Typically placed on swing highs or swing lows or consolidation points, right? Round numbers such as 10, 20, 100, 200 are all considered powerful key levels for price to reject or break through, right? Understand that key levels is not, when we're marking your support and resistance, it's not always about exact key levels because price doesn't usually always go to an exact area and reject that exact level. It's usually a key level mixed with a zone, right? So your key level might be 100, but it's gonna reject around that 100 zone, not necessarily specifically exactly at the $100 mark, right? So we're gonna go over the chart and you're gonna see what I'm talking about. Going over, now you also have trends, right? Trends are not powerful as key levels and zones, but they're just a guidance and price action for uptrend, downtrend, or sideways action. Now, it depends on how you look at trends. When you just consider trend and when you just put an uptrend on the chart and consider that an important level, that's false because an actual uptrend is marked by higher highs and higher lows. So for a price to break that uptrend, it doesn't mean the uptrend has broken until a higher low has broken. We'll go over that on the chart as well. Same thing with a downtrend, right? A lot of people put a downtrend line on their chart and feel as if that's a very key level. And price breaks out of the downtrend, but they end up getting stopped out. This is because the actual trend is still intact and a downtrend is marked by lower highs and lower lows. And if price doesn't take out that lower high, there hasn't been a shift in trend yet, right? So now, putting all this together, we have to understand how timeframes play a role. Higher timeframes are more reliable and powerful than intraday timeframes, right? Your monthly, weekly, and daily levels are, indicator of the bigger trend. Intraday levels, such as your 1 hour and 15 minutes, are good for day trading and intraday trading or sniper entries, but they don't necessarily determine the larger trend. You could find entries in those timeframes, but you have to look at the higher time frame for the direction of the trend. So now let's go over the chart. So when we're looking at this here, we want to look for areas where price has been reacting to, right? Let's just freestyle and draw our zones here. Like for example, we're going to draw zones here, here, and here as well. When we're looking at here, we see that this area is potentially a specific area where price has been rejecting at, right? We see that price has been rejecting this 4303.50 level a couple of times, right? The high of this candle is 4303, the high of this candle is 4303.50, and the high of this candle is 4303.50, right? Now, this is a key level, right? You have to understand that this is a key level. However, this key level is also a zone, right? This is a zone. And, you know, if price breaks out, we're looking for this key level and zone breakout, right? Because price could actually end up breaking out, but end up wicking this zone and price ends up pushing back down, right? So this zone and key level has to both break out. Now, when we're looking at here, right, this is a perfect example. Because as a beginner trader, you'd feel like this is your key level right here where price bounced at. And then when you go ahead and take a trade here, right, you get stopped out, right? You go short and then end up getting stopped out because you think that this key level broke. So that means obviously it's going to dump now. That's false because, again, this is a zone. If you go into higher time frames, right, you see how price ended up rejecting our zone here and ended up bouncing. See that? So you have to understand that, you know, just because it's a key level doesn't mean that's our, you know, exact really where price could, you know, dump or break out of. It's when you see things like this, then you could consider, okay, this is a key level. But typically, you know, those are not always common, right? These equal highs are not always common, right? So you want to understand that it's a zone. So now let's go over, you know, this zone ended up actually breaking and this key level ended up breaking as well, right? So this low became a key level. And look, what happened here at this key level, right? So once price broke out of it, it retested not specifically that key level, but this zone. It started retesting this zone, right? We see that we could draw this as a zone and we see that there has been multiple price action at this level, right? Price pulled back and rejected at the zone again and then dumped again, right? Now let's look where price ended up bouncing, right? Price ended up bouncing not specifically at this key level, but this zone, right? There's a zone here that price ended up bouncing off of, right? This could be drawn a lot cleaner right here like this. See that price ended up bouncing off this zone. Now, where did it end up breaking out? Look, it ended up retesting this key level and ended up breaking out of this, right? So now let's redraw our stuff, right? Now let's go over here and let's see how we could identify zones and key levels here, right? We want to look for where obvious price action has reacted to. So you can look for your obvious swing highs and swing lows when you're marking your key levels, right? You see that, right? This is our obvious swing high and swing low right here. And then we implement a level here, right? We can implement a level here, right? So every time price comes to the zone, right? We can implement the zone there. When price comes to that zone here, it bounces. And when price comes to this zone, upper zone here, it tends to break down, right? See how it's not breaking down at a specific and rejecting a specific price point, but rather a zone. And even here as well, it's not bouncing at a specific price, it's bouncing at a specific zone. So once the zone breaks, we could end up dumping, right? And then we could target our previous zones, right? We could target our previous zones from here to here, right? You can see that that was our previous zone where price ended up pushing up higher. And look what happens. Price breaks that down, doesn't retest a specific key level, but retests a zone multiple times before pushing lower, right? Now moving on, here when we're looking at a chart here like this, we want to identify, you know, some swing highs and swing lows. Typically your swing highs and swing lows, you can first mark by your key levels, right? And then you can start implementing your zones around that area, right? So you can understand that if price is approaching this level, there could be buyers and sellers stepping here. So there's not going to be sniper entries. There's going to be, you know, you got to understand it's not going to be a specific key level. It's going to be a zone where price could react at. So now for smaller consolidation, when looking at consolidation, right, you typically want to put key levels for consolidation. And you can also put zones, but, you know, key levels just make it a lot cleaner. For example, here we see that, you know, not only is price at a zone here, obviously, right? Essentially all key levels are zones, right? Price isn't always going to come to a specific level and just reject. It's going to come to an area and reject that level, right? An area around the specific key level, right? So all key levels, right, are zones, right? But not all zones are key levels, right? So this, for example, right here, right? If you go back here, this is a key level, right? Because price created equal highs. This is a key level. However, this area where price ended up bouncing is not a key level, it's a zone, right? It's not a specific price that price is rejecting, right? Same thing with here, right? Here we see that price is rejecting this zone. It shot below our key level here a couple of times, but ended up essentially rejecting the zone. This candle didn't come as low as this, but it rejected at this zone still. Now, when looking for a breakout trade, right here, and we also see another zone here as well, right? So I understand that price is entering a zone here, but my trade is still going to be a key level break, right? I'm looking for a key level break, right? And I confluence it with my zone break, and it becomes a higher confidence setup, right? So once my zone breaks and my key level gets taken out, like for example, 38.40 is my key level, and it's a zone that its price is sitting at, right? It rejected this zone. So once price pushes higher and breaks this zone and key level, then I'll look to go long. And where's my next target? My next target will be this zone. And you know, you can have your key level marked in these lows or these highs, right? Because it's a zone, because you don't know if sellers, let's say there's sellers here, you don't know if sellers are gonna start pushing from here, or they're gonna start pushing from up here, or from, you know, anywhere in, like maybe in the middle, right? You don't know when the sellers are gonna step in, right? They could step in right the moment it touches the bottom of this zone, or it could step in the moment it touches the top of this zone, or they could step in at the middle of this zone. You don't know that. So it's not a specific key level, it's a zone that price could reject at. So that's how you mark your levels here with key levels and zones. Let's go check out another chart. Here we have Boeing, right? Obviously, first you want to look at where price had the most reaction first, right? Where did price have the most reaction here? This is fairly obvious, right? We see that price has been rejecting this zone multiple times. Notice how it's not a specific price that prices have been rejecting, right? The chart hasn't been rejecting a specific price, but rather a specific zone. You see how here price broke out of these levels, but you know, it's still ended up rejecting it. So it just shows you it's rejecting a certain zone. So once its price is able to break out of this key level and zone, right? Break out of this zone. So my key level here will be these highs here, right? That high here will be my key level. And this zone here is the main thing I'm looking at. So once price breaks out of this zone, then I'll be like, okay, right? It looks like it's, you know, wants to push higher, and then we can go long, right? And then here, we also have a zone here, right? So we can consider that absolute low, our key level, but we have to understand that price is at a zone at the end of the day, right? It came towards this area and ended up bouncing. Notice how it didn't bounce exactly at the bottom of this level, right? But rather it pushed a little lower and pushed up higher. So it came to a zone, right? There were sellers waiting at this zone here for price to push higher. Now, if you look across this area right here, right, we see that price reacted here once, twice, 3 times, 4 times, 5 times, and 6 times. So that's an important zone here that price could push to, or reject at, or, you know, bounce out or break down at. So now what I'm looking for here, let's say price rejects this upper zone, right? I'm looking at this zone here, and my key level, which is this swing low here. So if price ends up pushing towards this swing low, takes out this key level and zone, then I'll be looking to go short in towards my other zone over here, right? So that's how I see it as, right? That's the way that I identify my support and resistance levels, right? So this is your resistance, this is your support, and this is your support here as well, right? Here is an example of price breaking resistance and turning it into support, right? Here, the breakout failed was because price didn't break this resistance and turn it into support. It broke this resistance and ended up getting rejected. So it didn't break it, it rejected this resistance, right? Here, we see that there's also zones here that's waiting on us if price ends up pushing higher, right? We see that price actually ended up rejecting this level over here, right? Price ended up rejecting this level. Let me fix this, excuse me, right? Price ended up broke this zone and key level. Notice how it's not a key level that got broken out, but rather a zone here, right? Price bounced off this zone, tried to bounce off here, couldn't, broke down, retested this level, right? So once it pushed here, consolidated a little bit, we see that, okay, that's an area that price is rejecting at. Broke that level, pulled back into that area and dumped. So now automatically we know that this area is not a key level, it's a zone, right? Pushed up, you know, and then bounced here, so we can identify that as a key level in a zone first. And then look where it started consolidating at, the zone again, not a specific price, but rather a zone. Pushed up and then started consolidating here. So we know that this is a zone here as well before pushing back down in towards this bottom zone. Did the same action again and again. And then here on a breakout, it retested this zone and rejected. So now if price breaks out here, I want to see how price reacts to this zone here before we can push higher. And if we push higher, I'm going to be looking at this next zone here in key level, right? Typically with gap fills, it's going to be straight key levels, right? So it's going to be from one level to the next, right? No zones involved in that. So this is how you incorporate zones and key levels together. Let's do another chart and then we'll call it a day. So here with Amazon, we see that price is bouncing off a specific level and a specific zone here as well, right? So it's incorporated, right? There's a key level and there's also a zone. We see that price bounced off this level, came here, bounced off, consolidated here, bounced off, pushed back in towards this area, bounced off, right? So it's an area around price, around the key level, right? Your support is an area around key level that price could bounce off at. And your resist, so this is considered your support. This is your floor, right? The more times that your floor gets tested, the weaker it becomes. Why is that, right? People think that the more times our support gets tested, that means it's a strong level. That's false. The reason is because every time price approaches this area, there's buyers that step in, right? There's orders waiting to be filled to buy, right? So price comes here, fills orders, right? So let's say there's 100 orders waiting to get filled here. First time price bounces, there's 30 buy orders that get filled, sends price higher. Next time price bounces, there's 50 orders that get filled, right? So 30 orders, then 50 orders. So 80 orders have been filled so far, and there's 20 left. So here, 10 more get filled. Then over here, 10 more gets filled. So what if price comes back next time and tries to retest this level? What if there's no orders left? There's no buyers left here. What's gonna happen is that price is just gonna break down. So the more times the level gets tested, the weaker it becomes because there's not enough buyers or sellers at that level to, you know, come back and help price push up or push down, right? So, you know, here, now we see that, now we can mark our key levels here as well. So we can go ahead and mark our key levels, like this obvious swing high is our key level, this obvious swing high is our key level, and this obvious high is our key level as well, right? Now these are all zones. Why? Because if you go here, right, this is an entire zone of its own because price didn't reject at these specific highs here, right? It wicked and closed below that level, but look where it rejected. It pushed in towards a zone and rejected, right? Here as well, this area is a zone as well. So you see that price here, right? These areas here are zones as well, right? Price consolidated here a little bit. There's not as much action, but you know, it's considered a zone still, right? We want to consider this a zone because it rejected this area. There's not a specific key level that rejected, right? Price just pushed up here and ended up rejecting here. And we see that, you know, there has been sharp reactions at this level as well. You know, price pushed up very aggressively. Price broke down very aggressively at this zone. So now, that's how we identify it. Now, there's a smaller one here in the middle that we could see as well. Price reacted to it one time here, twice, 3 times, 4 times, 5 times. And so this is our other zone here as well. If you guys look, right? Here we see that price is reacting to this area, right? Now, when I'm looking for sharp entries, right? I'm not necessarily looking at specific zones, right? I'm more of a key level trader. I want to see obvious swing highs and swing lows to be formed at either support or resistance. Then I'm looking for a breakout of that support and resistance key level, right? So for example, here, right? I'm not just going to go long or short the moment price enters my zone here. Typically, as a zone trader, when price enters your, your support, you look to go long, and when price enters your resistance, you look to go short until your trade gets invalidated of that support and resistance break, right? So we see here that price broke this, retested it, ended up pushing down. So as a beginner trader, if you don't understand how, where your key levels should be, where your specific key levels should be, start implementing zones. Look for where there have been obvious price reactions to, and look to implement zone trading at these areas, right? When you see prices just rejecting your zone multiple times, most likely it's going to bounce a couple times, right? The first couple times it's going to come to that level, it's going to bounce. Then if it starts rejecting it a lot of times and start coming to that zone a lot of times, just keep in mind that it's getting weaker and weaker, right? So here we see that price pushed up into towards this zone, consolidated at this zone a little bit before it started pushing higher. Here is when you want to implement key levels here as well, right? We see that price has been, creating an obvious, high and low here, right? So now, if you're breakout trading, right, and you're doing key levels, you see that price is bouncing off your zone, right? And you have your obvious swing highs and swing lows. So once price breaks that key level, you can look to go long in towards your next zone, right? And that's how you can implement zones in your trading. That's about it, guys. Thank you guys for watching. I appreciate everyone for, watching this video. I hope it helped you guys understand zones and key levels better. There's going to be more videos on support and resistance, a lot more videos on support and resistance. I'm really going to clarify this topic for you guys and help you guys understand it at a completely different perspective. So make sure you guys like and subscribe and watch out for the next video. Thank you guys for watching. I'll see you guys in the next video. Peace out.